All right, let's chart a course through the world of technical analysis. You ready?
Always.
Okay, great. So we're diving deep into the source material you provided. A whole book on this subject.
Technical analysis of the futures markets, yeah.
It's a bit dense, so we've got our expert here to help us break it all down. But what really intrigued me, even before we look at the charts and graphs, is this idea that you can predict the future just by studying the past.
I know, it's a bold claim, right?
It is a bold claim.
Yeah, the core philosophy of technical analysis is that all the information you need about a market is reflected in the price action. So that's the price, volume, open interest, all of it.
So you're saying no need to read through those long company reports or economic data like all those fundamental analysts do?
Yeah, that's the technician's view, at least. They believe that stuff is already baked into the price.
Interesting.
Now, whether that's completely true, I think that's debatable.
Right.
But it is a very different way of looking at the markets.
Yeah. Instead of asking, like, why the market's moving, they're asking where is it likely to go next, just based on its past behavior.
Absolutely.
It's almost like looking for clues in a detective novel, right?
Yeah.
Except the clues are price patterns and all those candlestick things.
Exactly. And just like a detective, they use all sorts of different tools and techniques to put that puzzle together.
Speaking of candlestick charts, they seem to be, I don't know, super popular these days.
Yeah.
What makes them so special? I mean, compared to like regular bar charts.
Well, think of it this way. A candlestick chart, it not only shows you the price range, for a certain period, but it also tells you if the market closed higher or lower than it opened. And they do this visually with these little bodies that are either filled or hollow. It's almost like they're showing you the market's mood for that day.
So you're saying just by looking at the shape of these candles, you can kind of get a sense of whether the buyers or the sellers were in control that day?
Exactly. And there are so many patterns that these candlesticks can form, each with their own meaning.
Really?
Oh, yeah.
Yeah. But
before we jump into those patterns, we have to understand the foundation of it all. And that's Dow theory.
Right. The granddaddy of trend following. I gotta admit, that whole phrase, the averages discount everything, it sounds kind of, I don't know, mystical.
Yeah.
Like some kind of market prophecy or something.
It does have a certain mystique to it, doesn't it?
It does.
What it means is that Dow theorists, they believe that all the information, whether it's news or earnings or even just rumors,
right,
it's all factor into the price.
Okay.
So by studying price action, you're essentially tapping into the collective wisdom or maybe even the madness of the market.
Okay, that makes a little more sense. But how do you know which of those price movements are actually significant and which ones are just noise? I mean, the market can be pretty unpredictable, right?
Well, that's where trend analysis comes in. And Dow theory really emphasizes that trends are your friend. They're the most powerful force in the market, and they usually continue until there's a very clear sign of a reversal.
So you're saying don't try to time the market and predict the exact top or bottom.
Patience is really key when it comes to technical analysis. You want to wait for the market to confirm your suspicions.
And how do you get that confirmation?
Well, one way is to look for confirmation between different market averages. So Dow theorists usually look at the Dow Jones Industrial Average, and then they compare it to the transportation average. The idea is that for a trend to be valid, both of these averages need to be moving in the same direction.
So it's like a checks and balances system for the market.
Exactly.
Interesting.
So if one is making new highs, but the other is lagging behind, that's a red flag.
Gotcha. So finding those trends, the reversals, that's where charting comes in, right?
Right.
The visual language of the market. The book actually mentions a whole bunch of different types. Bar charts, line charts, those candlestick charts that we talked about, even something called point and figure charts. It's a little overwhelming, honestly.
Don't worry, you don't need to be a master of every single charting technique to be a successful technical analyst. The important thing is to find one that speaks to you, one that helps you see the market clearly.
So you're saying find one you like and stick with it?
Pretty much, yeah.
Okay, so let's say I've set up my chart, I found a potential trend. What do I do next?
Well, the next step would be to look for support and resistance levels. Think of these like battlegrounds between the buyers and the sellers.
Okay, so support is like a floor where the buyers tend to step in, and resistance is like a ceiling where the sellers start to take over.
Precisely. And these levels are usually based on the market's memory.
Market's memory.
Yeah. Traders, they remember where prices struggled in the past, and they act accordingly when those levels are approached again.
So it's like the market has a subconscious or something.
Okay.
And it's haunted by its past.
In a way, yes. And the strength of these memories or these support and resistance levels, it varies.
Really? What does it depend on?
Well, one thing is the amount of trading volume that happened at a specific level.
Okay.
Think of it this way. The more people who bought or sold at a certain price, the more significant that level becomes.
So it's kind of like a crowded train station. The more people who are getting on or off at a certain stop, the more important that stop is.
Exactly. And the length of time that prices stay at a certain level also matters.
How so?
Well, the longer they stay, the stronger that memory is. It's like the difference between a fleeting thought and a deeply held belief.
Gotcha. So if a stock has been trading between, let's say, $50 and $60 for months, that's a stronger support and resistance zone than if it just touched those prices briefly.
Precisely.
Okay, that makes sense. So we've got our charts, we found our trends, we're paying attention to support and resistance. What other clues are we looking for in this market detective novel?
Well, one of the most fascinating parts of technical analysis is studying price patterns.
Okay.
These are the formations that repeat, and they can tell us a lot about the balance of power between the buyers and the sellers.
So you're talking about a secret code hidden within these price movements.
You could say that.
All right, I like that. Give me more.
Okay, so these patterns, there are two main types. Reversal patterns, suggesting a potential change in the trend, and then continuation patterns, which mean that the existing trend is likely to continue after a pause.
Let's talk reversals.
Yeah.
The book actually focuses on this classic head and shoulders pattern. Sounds a bit ominous, doesn't it?
That does, doesn't it?
Yeah, a little bit.
So imagine a chart with a high peak in the middle and then two lower peaks on either side. That's your head and shoulders.
Okay, I can picture it. But how does that tell us anything about the future direction of the market?
Well, usually the head and shoulders pattern forms after a long uptrend. So as the market makes that last push higher to make that head, it can be a sign that the bulls are getting tired.
Like they've run out of steam.
Exactly. And then those lower shoulders on the side, they show that the buying pressure is weakening and the sellers are starting to gain control. And then once the price breaks below the neckline, that's the line connecting the lows of the two shoulders.
Right.
That's often seen as confirmation that the trend has reversed.
So it's not just about the shape of the pattern, but also about the price action confirming it.
Absolutely. And there's even a technique for estimating how far the price might fall after this head and shoulders pattern completes.
Oh, tell me more. Is this where the crystal ball comes in?
No crystal ball needed. It's actually pretty straightforward. You measure the distance from the head to the neckline, and then you project that same distance downwards from the neckline breakout point. It's not a perfect science, but it gives you a general idea of how far the market might fall.
Okay, that's interesting. So if we understand these patterns, we can not only see those reversals coming, but we can get a sense of how far the price might move in the other direction.
That's the power of technical analysis.
Yeah.
It helps us understand the market's language and try to predict what it's going to do next.
Okay, but before we go too far down that road, the book really stresses that volume is super important for confirming these patterns.
Absolutely. Volume is like the fuel for those price movements. So if you see a head and shoulders forming, but it's on low volume, it's not as reliable as one that's forming on high volume.
So it's not just about the shape, but about the force behind it, so to speak.
You got it.
Interesting. And you know what? I was reading, there's a little tidbit here, that volume is even more important at bottoms than at tops.
You're right, it is.
Why is that?
Well, markets, they tend to fall under their own weight, like a house of cards. It doesn't really take much selling pressure to push prices lower, but to reverse a downtrend, you need strong buying pressure. And that's reflected in higher volume.
So like the market needs a little shot of adrenaline to get back on its feet.
Yeah, think of it that way. So that surge in volume on an upside breakout, that's a really bullish sign.
Gotcha. So we've covered price patterns, but the book also mentions volume and open interest, particularly when it comes to futures markets. What is open interest?
Well, open interest refers to the total number of outstanding futures contracts. So it's essentially a measure of how much money is actually committed to that market.
So if open interest is rising, it means more traders are jumping in.
Yeah, that's one way to look at it. But it's not always that simple. The relationship between price, volume, and open interest, it's nuanced.
Okay, I'm ready for some nuance. Lay it on me.
All right, so rising open interest during an uptrend. That's generally a bullish sign because it suggests that new money is coming in, fueling the rally.
More buyers, higher prices. That makes sense. I feel like this is where it's going to get tricky, though.
All right, well, here's where it gets interesting. Rising open interest during a downtrend can actually be bearish.
Wait, hold on. How can more traders coming in be a bearish sign?
Well, in that case, it might mean that there are new short sellers entering the market, which adds to that downward pressure.
So it's not just about whether it's rising or falling, but the direction of that price trend as well.
Exactly. Context is everything when you're looking at open interest. Now, declining open interest during an uptrend, that can be a warning sign. It might mean the rally's losing steam, and it could just be driven by short covering, not new buying.
Short covering, what's that?
It's when traders who had previously sold short, essentially betting on the market to go down, well, they have to buy back their positions to cover their losses as the market moves against them.
So they're scrambling to get out of those losing bets.
Exactly. And that buying pressure can sometimes make the uptrend look stronger than it really is, even though the real momentum is weakening.
So it's like a false signal.
In a way, yeah. Now, on the flip side, declining open interest during a downtrend can be bullish. It might mean that the short sellers are covering, taking their profits, and potentially setting the stage for a reversal.
So the selling pressure eases up, and maybe the market starts to turn around.
That's the general idea. But it's really important to look at everything: the price action, the volume, and open interest, to get a complete picture of what the market's really doing.
It's like three-dimensional chess. But what happens when those short sellers really get squeezed? The book mentions something called forced liquidation.
Ah, forced liquidation. That's where things can get really interesting, especially in futures markets, where traders are often using leverage.
Remind me, what's leverage again?
It's basically borrowing money to amplify your trading position.
Right.
It can magnify your profits, but it can also magnify your losses.
A double-edged sword for sure.
Precisely. Now imagine a trader, he's using a lot of leverage, and the market moves against them.
Oh.
They might get what's called a margin call from their broker. Essentially, they're being asked for more money to cover those potential losses.
And what happens if they don't have the cash?
Then they're forced to liquidate their position, regardless of what their analysis or outlook was. And when that happens on a large scale, it can create a domino effect, pushing prices down even further.
Yikes, that sounds dangerous.
It can be. Forced liquidation is one of the main reasons why futures markets are so volatile. But it's also a reminder of why money management is so important, which we'll talk about later on.
Definitely something to keep in mind.
Okay.
Before we move on, there's one more report that the book mentions called the Commitments of Traders, or COT report. What is that?
The COT report, it basically tracks the positions of different types of traders in the futures market. So that would be commercials, large speculators, and small speculators.
So you're saying we can see what the big players are doing?
In a way, yeah. By looking at that COT data, we can see who's holding what and how those positions are changing over time.
And how does that help us make better trades?
Well, one way is to use it in a contrarian manner. For example, if everyone's super bullish on a particular market.
You're thinking maybe it's a sign that it's overbought and a correction is coming? Kind of like that saying, buy when there's blood in the streets?
Exactly. That contrarian thinking can be powerful, but it takes a lot of discipline to go against the crowd.
It does. Okay, so we've been talking about these short-term charts and indicators. But the book also says it's really important to take a longer-term perspective. Why is that?
Well, looking at weekly charts or even monthly charts, that can help you see the bigger picture and identify those long-term trends that can really move the market. It's like the difference between looking at individual trees versus the whole forest.
That makes sense. But charting futures contracts over the long term, that could be tricky, right? Because they expire.
You're right. You can't just chart one single contract forever. You need to find a way to stitch together different contracts to create a continuous price series.
Okay.
That's where continuation charts come in.
Gotcha. So it's like you're making a historical tapestry of the market's movements.
Exactly.
Interesting. And the book actually has a really cool example of this. A 20-year uptrend line in the Dow Jones Utilities Index.
Yeah. It just shows how powerful those long-term trends can be. Even in a market that seems as random as the stock market, there are these underlying forces that create order and predictability over time.
That's amazing. Okay, so we've got our long-term perspective. Now let's talk about some tools that can help us smooth out those bumps and identify those trends. So moving averages.
Ah, yes. Moving averages are like a window into the market's underlying direction. They help filter out all that noise from the day-to-day fluctuations and reveal that smoother trend.
So it's like if you took a moving average of your own mood over a whole week, It would smooth out all the highs and lows and give you a better idea of your overall emotional state.
Exactly. And there are different types of moving averages, each with its own calculations and characteristics.
Okay, like what?
Well, there's the simple moving average, which gives equal weight to all the prices.
Right.
And then there's the exponential moving average, which gives more weight to the recent prices, so it's a little bit more responsive to market changes.
So it's like choosing between a slow-moving tanker and a nimble speedboat.
I like that analogy.
Yeah.
It's a good one. And, the best choice really depends on your trading style and the time frame that you're looking at.
Makes sense. The book mentions a simple but effective system using the 4-week moving average. It's called the weekly rule. What's that about?
The weekly rule basically says that if the price closes above that 4-week moving average, you go long. And if it closes below, you go short.
Sounds pretty straightforward. Buy when it's above, sell when it's below.
Well, in theory, yeah. But of course, there's more to it than that. You have to look at the bigger trend, the support and resistance levels, and consider your own risk tolerance.
Right, there's no such thing as a perfect trading system. But it does show how even a simple moving average can be used to find those potential trends.
Exactly.
Okay, so the possibilities are endless.
They are, pretty much.
Cool. Speaking of endless possibilities, let's talk about another set of tools. Oscillators. What are those?
Oscillators, they're like a thermometer for the market's emotions. They help us see when the market is overbought or oversold, which can signal potential turning points.
Okay, so if an oscillator is really high, it's like a sign that things are getting a little too heated, like a rubber band that's stretched too far.
Exactly. And then on the flip side, if it's really low, it might mean the market is oversold, like a spring that's been compressed and is ready to bounce back.
Okay, I like those analogies.
Yeah.
Now, the book mentions a whole bunch of different oscillators, RSI, stochastics, MACD. Do we really need to understand all of them?
You don't need to memorize every single formula. The important thing is to understand the general concept of how they work and how they can be used in conjunction with price charts to analyze the trends.
So understand the principle, not just the numbers.
Right. Each oscillator is a little bit different, but they all have the same goal to help us see those potential turning points in the market.
And one of the most useful things about oscillators is that they can show us those divergences, right? Which can warn us that a trend is weakening even before the price action confirms it.
Exactly. A divergence happens when the price is making, say, higher highs, but the oscillator is making lower highs. It's like the market saying one thing with the price, but something different with its momentum.
So it's like getting a little sneak peek behind the scenes.
You could say that. And this is where oscillators can be really valuable by alerting us to those potential shifts in sentiment that we might not be able to see just by looking at the price chart.
Okay, I see how all of these different tools can work together to give us a more complete picture of the market. But let's not get too carried away with all these indicators. The book actually goes into a much more, mysterious approach to market analysis. Elliott wave theory.
Elliott wave theory. It's controversial, but it's also fascinating. Basically, it says that market movements follow a very specific pattern. 5 waves in the direction of the trend, and then 3 waves against the trend.
Okay, so 5 waves forward, 3 waves back. It sounds almost like a dance.
Right. And the interesting thing is that these waves are fractal, which means they repeat themselves at different scales. So one 5-wave impulse wave can be broken down into smaller 5-wave patterns, and those can be broken down even further.
It's like those Russian nesting dolls, where you keep opening them and there's another one inside.
Exactly. And the idea is that if you can correctly identify these waves and their subdivisions, you can, in theory, predict future price movements very accurately.
That's a big claim. Isn't Elliott wave theory super complex and kind of hard to interpret?
It is. That's why it's so controversial. But for those who are really willing to put in the time and learn it, it can be a very powerful tool.
The book does mention a couple of interesting concepts within Elliott wave theory, like this rule of alternation and something called channeling. Could you explain those a little bit?
Sure. The rule of alternation, it suggests that those corrective waves, the 3 waves that go against the main trend, well, they tend to alternate between simple and complex patterns. So if one correction is just a simple zigzag, the next one is more likely to be a more complex pattern, like a triangle or a flat.
So it kind of helps you narrow down the possibilities.
Exactly. And channeling involves using trend lines to help identify potential price targets and confirm those wave counts. You basically draw parallel lines connecting the peaks and troughs of those waves to create that channel.
So prices tend to stay within those channels. And if they break out, that could signal a big change.
Precisely. And those trend lines can also act as support and resistance levels within that overall Elliott wave pattern.
It's like those lines on the highway. keeping the market going in the right direction.
Yeah.
What happens if the market veers off course, though? The book mentions wave 4 being important as a potential support area, especially in bear markets. Why is that?
Well, a lot of times after a 5-wave advance is finished and a bear market starts, the decline usually doesn't go below the low of that previous 4th wave.
So it's like a line in the sand that the market respects.
You could say that, yeah. But keep in mind, it's not a foolproof rule. Markets can always surprise us.
Right, always. Okay, so we've covered waves. Now we're getting into some really mysterious territory here. Time cycles.
Yeah.
This is where it starts to sound a little bit like astrology, right?
Well, some people might say that. Time cycles are basically the idea that market movements are influenced by these repeating patterns in time, like the seasons or the cycles of the moon. It's really interesting, but it's not for everyone.
I can imagine. So instead of just looking at those price patterns on a chart, we're also looking for patterns in time, like some kind of rhythm.
That's a good way to think about it. And there are analysts who have spent their whole careers studying these cycles, trying to figure out the market's hidden rhythms. The book talks about some really cool cycles that were discovered by this guy named Edward R. Dewey, who found these repeating patterns in everything from salmon abundance to cotton prices.
Wow, it's amazing to think that there could be these underlying cycles that influence such unrelated things.
I know, right?
And apparently Dewey also found a 9.2-year cycle in the stock market, which has been pretty accurate over time.
It's true. And that's just one example of the many cycles that have been discovered. And while they don't always work perfectly, they can offer valuable insights into how the market ebbs and flows.
So even though markets can be chaotic, there might be some underlying order and rhythm to their movements.
That's the basic idea behind cycle analysis. And while it's not perfect, it can help us anticipate those turning points and make more informed decisions.
Okay, so we've explored a whole range of tools and concepts here, from the basics of charting to the complexities of Elliott wave theory and time cycles. But how do we actually put all this knowledge into practice? That's where computers and trading systems come in, right?
Exactly. Computers have changed everything when it comes to technical analysis. They allow us to backtest our ideas, to optimize them, and even to automate our trading strategies. It's like having a super-powered trading assistant.
And the book lays out a kind of 5-step plan for building a trading system, starting with a concept and then turning that concept into a set of very specific rules.
Yeah, so you have to define your entry and exit criteria very clearly. No room for guesswork. If you're using, let's say, a moving average crossover, you need to know exactly which moving averages you're using and what the price needs to do in relation to those averages to trigger a buy or sell signal.
Got it. And then you visually check it out on the charts just to see how it would have performed in the past.
Exactly. You want to get a feel for how the system would have generated those signals in different market environments.
Makes sense. And then the fun part begins. You actually test it on a computer using historical data.
The computer does all the hard work for you. It analyzes all the numbers and tells you how much money the system would have made or lost over a certain period of time. And it factors in things like trading costs and slippage.
Right, so you get a real sense of whether this system is actually viable.
Exactly.
Now, one thing the book really emphasizes is that you need to test your system on multiple markets. It's not enough for it to just work on one or two.
Absolutely. A really good trading system should be able to adapt to different market conditions and perform well across different asset classes.
So it's like a universal language for the markets.
I like that.
Yeah.
It speaks to those underlying principles of technical analysis, which are based on the idea that at the end of the day, human behavior is what drives markets.
The book also says it's important to actually look at those computer-generated trading signals on a price chart.
Yeah.
Why is that step important?
Well, sometimes a system might look really good on paper, but then when you actually plot those signals on a chart, you realize it's not something you'd actually feel comfortable trading. Maybe the signals are too frequent, or maybe they're happening at points that don't make sense to you.
So it's about trusting your gut as well as the numbers.
That's right. Intuition and experience are still important in trading, even with all these fancy computer programs.
Absolutely. So let's talk about one of the coolest features of trading software, optimization.
Optimization allows you to adjust all the different settings in your system to find those that would have performed best in the past. So, for example, you could optimize the length of your moving averages or the overbought and oversold levels of your oscillators.
So it's like you're fine-tuning a musical instrument.
I like that. But as the book cautions, there's a danger in over-optimizing.
Because you could end up creating a system that performs really well on past data, but then falls apart in the real world.
You're right, exactly. You're basically curve fitting your parameters too closely to the past, and then it doesn't perform well in the future.
So how do you avoid that?
Well, one way is to use part of your data for optimization and then another part for testing. That way you can see how well your optimized system does on what we call out-of-sample data.
Data it hasn't seen before.
Right.
Okay, that makes sense. So it's really important to make sure that your system is actually viable, not just a product of playing with the numbers.
Absolutely. And even if you don't want to completely automate your trading, the book says you can use those signals as kind of a confirmation or as a filter for your own trading ideas.
So say a value investor could use a technical system to help them figure out the best time to buy or sell.
Exactly. Even fundamental analysts can benefit from using those technical signals in their decision-making.
It's all about finding the right balance between human judgment and the power of these computer programs.
That's right. We need to use technology to our advantage, but we also need to use our own critical thinking.
Speaking of critical thinking, there are a few more advanced technical concepts in the book that I think our listeners will find really interesting.
Oh, yeah. Like what?
Well, one of them is the demand index. What's that all about?
The demand index is a cool tool. It combines price and volume to create what's called a leading indicator. So it can show you shifts in buying and selling pressure, even before the price action confirms it.
Wow. So you're saying it can tell us what the market's going to do before it happens.
Well, not exactly telling us, but it's giving us hints. It's like a detective finding footprints leading away from a crime scene. Those footprints don't tell you exactly who did it, but they give you a place to start.
I like that analogy.
Yeah.
And you can also use the demand index to spot those divergences, right? Just like with oscillators.
Exactly. Remember, divergences are really important, and you can see them in a lot of different indicators. In the case of the demand index, a bullish divergence happens when the price is making lower lows, but the demand index is actually making higher lows.
So the price is getting weaker, but the underlying buying pressure is actually increasing.
That's right. And that can be a strong signal that a reversal is coming.
Okay, that makes sense. Now, the book also mentions another interesting indicator called the Herrick Payoff Index. What makes that one special?
The Herrick Payoff Index was specifically designed for futures markets, and it includes open interest in its calculation. So it's basically a measure of the money that's flowing in and out of the market.
So it's not just about the price and volume, but about how much capital is being committed.
Exactly. And just like the demand index, the Herrick Payoff Index can show you those divergences. For example, a bearish divergence happens when the price is making higher highs, but the Herrick Payoff Index is making lower highs.
So the price is going up, but the money flow is actually getting weaker.
You got it. It suggests that maybe the rally is losing steam and a reversal is possible.
These divergences seem to be popping up everywhere.
They are. They're one of the most powerful concepts in technical analysis, and you can apply them to so many different indicators. It's all about looking beyond the surface of the price action and trying to see what's really driving the market.
Okay, I'm definitely going to keep an eye out for those divergences. Now, the book also mentions this charting technique called market profile, which is a totally different way of visualizing market activity, right?
Yeah, market profile is interesting. It basically takes price and time data and organizes it in a way that shows you the market's auction process.
So this isn't your typical bar chart or candlestick chart?
Nope, not at all. A market profile chart looks more like a histogram or a bell curve. It shows you how much time the market spent trading at different price levels during a certain period.
Interesting. So how does that help us make better trades?
Well, market profile can give you some insights into the balance between buyers and sellers, if there are any large traders in the market, and the potential for future price moves.
It's like getting a glimpse into the market's inner workings.
You could say that, but it's definitely a more advanced technique. It takes time and practice to get it right.
All right, I'll add it to my list of things to learn.
Good idea.
Now, the book is very honest about the challenges of technical analysis. It recognizes that markets are unpredictable and that there's no such thing as a perfect system.
You're right. There's no magic formula.
Right.
No system that can predict the market 100% accurately.
But what it does say is that technical analysis can give you really valuable insights into how the market behaves, help you find potential trading opportunities, and manage your risk.
And it can also help you manage your risk more effectively.
Absolutely. So even if you're not, a full-time trader,
Yeah.
those technical analysis concepts can really help anyone who's involved in the markets.
Right, whether they're day trading, swing trading, or investing for the long term.
Yeah, it's like having a secret weapon in your investing arsenal.
I wouldn't wouldn't call it a secret weapon, but it's definitely a valuable tool to have.
Yeah, for sure. The book also talks about the importance of always learning and always adapting because the world of finance is always changing.
Right, you have to stay ahead of the curve.
You do. And one of the best ways to do that, it seems, is by connecting with other technical analysts. The book mentions the Market Technicians Association.
The MTA, yeah.
The MPA, a global organization that's all about promoting the study and practice of technical analysis.
Yeah, it's a great resource.
It sounds like a good place to network and learn from the pros.
Absolutely. They have educational resources, conferences. They even offer a professional designation. The Chartered Market Technician.
The CMT.
Yeah.
It's like getting certified as a master chart reader.
Not quite, but it does show a commitment to the field and a high level of knowledge.
That's pretty cool. I'm definitely checking out their website after this deep dive.
You should. Now, before we move on, I wanted to mention a couple more of these advanced technical concepts that the book highlights.
Okay, I'm ready. Bring them on. I feel like I'm becoming a technical analysis ninja.
Well, one that I found really interesting is the ARMS index.
The ARMS index. What is that? Does it involve measuring the length of your arm compared to your computer screen?
Not quite. The ARMS index, or TIN, is basically a ratio. It compares the volume in stocks that are advancing to the volume in stocks that are declining.
So it's like a way to see the overall buying and selling pressure in the market.
That's it. If the ARMS index is high, it means more volume is going into those declining stocks, which is generally a bearish sign.
And if it's low?
Then it's the opposite. More volume in the advancing stocks, so it's bullish.
Gotcha. So you can use this both for short-term trading and for longer-term trends.
You can. It's like taking the market's pulse.
I like that. Okay, now the book also mentions something called equivolume charting. What is that?
Equivolume charts are interesting. They combine the price and volume data into a single bar.
So instead of having separate bars for price and volume, it's all in one.
Yeah, exactly. The width of the bar shows you the volume traded during that time, while the height still shows you the price range.
Okay, I can see how that would make it easier to see which periods had the most activity.
That's the idea. You can easily spot those high volume periods, whether it's accumulation or distribution, which can give you clues about where the price might go next.
Wow, it seems like all these different tools really work together to give you a much better understanding of the market.
That's the thing about technical analysis. It's not about finding that one magic indicator. It's about using multiple tools together to confirm your analysis.
So it's like a detective using fingerprints, DNA evidence, and eyewitness accounts to solve a crime.
Exactly. Each piece of evidence strengthens the case.
All right, good analogy. Speaking of building a case, the book also talks about the importance of intermarket analysis. What is that exactly?
Intermarket analysis is basically the idea that different markets are all connected and they influence each other.
So what happens in the bond market, for example, could affect the stock market.
Exactly. If interest rates are rising in the bond market, that could be a problem for the stock market because it makes it more expensive for companies to borrow money.
Makes sense.
Yeah.
And if commodity prices are falling, that could be a sign of weaker global demand, which could also hurt stock prices.
That's right. By looking at these relationships between different markets, you can get a better understanding of the bigger forces that are at play.
It's like seeing the whole forest, not just the trees, and the ecosystem around it, too.
I like that. Now, one of the most common applications of this intermarket analysis is the relationship between stocks and bonds.
Yeah, the book says that the bond market is often seen as a leading indicator for the stock market.
It is. Bond traders tend to react to changes in economic conditions first, and what they do can sometimes predict what's going to happen in the stock market.
So if bond prices are dropping, that could be a warning sign for stocks.
It could be bond yields, which move in the opposite direction of prices, can also give you some clues. If yields are going up, that could mean inflation is a concern, or that there are worries about future economic growth, which can be bad news for stocks.
So even if you're mainly focused on stocks, it's still a good idea to pay attention to what's happening in the bond market.
For sure, intermarket analysis is all about connecting the dots and seeing the bigger picture.
All right, so we've talked about intermarket analysis. Now let's dive into some stock market indicators. What are those?
Stock market indicators are essentially mathematical calculations. They're based on price and volume data, and they can give you insights into the overall health and direction of the market.
It's like having a dashboard for the market, right? You can see all the gauges and dials to get a sense of what's going on.
I like that. One of the most popular ones is the advanced decline line.
Advanced decline line. Okay, what does that tell us?
It measures something called breadth, which is how many stocks are actually participating in a rally or a decline.
So how many stocks are going up and how many are going down?
Exactly. You calculate it by subtracting the number of declining stocks from the number of advancing stocks each day.
So if the market is really bullish, you'd expect to see more stocks going up than down, right? And the advanced decline line would be rising.
Exactly. And if the market is bearish, then the line would be falling.
Gotcha. So it's kind of like taking the market's temperature.
I like that analogy. A healthy market usually shows a rising advanced decline line, along with rising prices. It means that a lot of stocks are participating in the rally.
So it's not just a few big stocks carrying the whole market.
That's right. And if the advanced decline line starts to diverge from the price action, that can be a warning sign.
So if the market is making new highs, but the advanced decline line is making lower highs, that could mean the rally is losing steam.
Exactly. It might be time to start getting cautious.
Okay, that's good to know. The book also mentions the McClellan oscillator and the McClellan summation index. What are those all about?
Those are a little more complex. They're also breadth indicators, but they use moving averages of the advanced decline data to smooth out the fluctuations.
It's like a more refined version of the advanced decline line.
You could say that. The McClellan oscillator is a short-term indicator, while the summation index is a longer-term indicator.
So you can use them together to see both the short-term and the long-term picture.
Exactly. Now, one more indicator that I wanted to mention is the tick index.
The tick index. Is that related to those little bugs that bite you?
Not quite. The tick index measures the difference between the number of stocks trading on an uptick and the number of stocks trading on a downtick.
So it's a real-time look at the buying and selling pressure in the market.
That's it. If the tick index is positive, it means more stocks are trading on upticks, which is generally bullish.
And if it's negative?
More stocks are trading on downticks, so it's bearish. It can be a very volatile indicator, but it can give you some valuable insights into what's happening in the market right now.
Okay, so we've covered intermarket analysis and a whole bunch of different stock market indicators. What about those candlestick charts we were talking about earlier?
Right, remember those?
Yeah.
They're not just pretty to look at. They actually tell you a lot about the psychology of the market.
I remember. They can show us those reversal and continuation patterns.
Right, like the doji candlestick, which looks like a little plus sign, and it usually means the market is indecisive.
Or the hammer candlestick, which has that long lower shadow and a small body. It's like the sellers tried to push the price down, but the buyers stepped in and pushed it back up.
Exactly. It's like you're reading the market's emotional tea leaves.
I like that. And what's cool about candlestick charting is that it combines that objective price data with the human psychology behind those movements.
You got it. So it's not just about crunching numbers. It's also about trying to understand the emotions that are driving the market.
Okay, now we've discussed a lot of different concepts and techniques, but the book makes it clear that there's no single right way to do technical analysis, right?
Absolutely. It's more of an art than a science.
So it's all about finding the tools and approaches that work best for you, developing your own style.
Exactly. Some people love chart patterns. Others prefer indicators. Some trade for the short term, others for the long term. There's no right or wrong answer.
It's like being a chef, right? You can use the same ingredients to create all sorts of different dishes.
Perfect analogy. The most important thing is to find something that suits your personality and your risk tolerance.
That makes sense. The book also says it's important to come to the market with an open mind, a willingness to learn, and maybe a little bit of skepticism.
Right. You have to be willing to question your assumptions and be open to new ideas.
And you always need to be learning and adapting as the market changes.
Technical analysis is a journey, not a destination. It's always evolving.
Well said. We've covered a lot of ground in this deep dive into the world of technical analysis.
We have, from the basics to some pretty advanced stuff. It's been a great overview.
I think we've given our listeners a lot to think about.
Hopefully. And I encourage them to keep exploring. There's always something new to learn. And who knows, maybe they'll discover their own way of understanding the language of the markets.
Okay, that's a great point. Before we wrap up this part, I want to remind our listeners that the book we're talking about, Technical Analysis of the Futures Markets, is a fantastic resource if you want to dig deeper.
Absolutely. It's got everything you need. It's comprehensive, covers a wide range of concepts, and explains those tools and techniques really well.
And it's written in a clear and easy-to-understand way. So it's great for beginners, but also has a lot for more experienced traders.
It's a classic. And it's by John J. Murphy, who's a leading expert in this field.
Right. He's written a ton of books on technical analysis, so if you're looking for more,
There's plenty out there.
Yeah. Plus, there are tons of resources online and in libraries. So if you're eager to learn, the information is definitely out there.
That's right.
All right, I think it's time to move on to the last part of our deep dive.
Okay, sounds good. It's like having a roadmap to help you navigate those choppy financial markets.
Yeah, that's a good analogy. And even if you're not like a professional trader, these concepts, this stuff we're talking about, it can be applied to, well, really any kind of investment decision, right?
Absolutely. Knowing about trends, support, and resistance, understanding how the market thinks, that can benefit anyone who's involved in the markets. Whether you're a day trader, a swing trader, a long-term investor.
It's like having a secret weapon in your back pocket.
Maybe not a secret weapon, but definitely a valuable tool.
Yeah. All right, so the book covers a lot, but it's very honest about the challenges of technical analysis.
Right.
It acknowledges that the market can be unpredictable and no system is going to be perfect.
Right, you have to be realistic.
But what it does stress is that technical analysis can provide some really good insights into how the market behaves. It can help us see those potential trading opportunities. And, maybe most importantly, it helps us manage risk more effectively.
That's right. You have to protect your capital.
Absolutely. Speaking of protecting your capital, we need to talk about money management, which is something that I think a lot of traders, especially beginners, tend to overlook.
Yeah, it's easy to get caught up in finding that perfect entry signal and then forget about the downside.
Right, exactly. It's like building a beautiful house on a shaky foundation. It might look good at first, but it's not going to last.
That's a good way to put it.
The book really emphasizes that money management is just as important as, if not more important than any indicator or any fancy charting technique.
Absolutely. It's the foundation of everything.
Yeah.
Without good money management, you can have the best system in the world and still lose everything.
Okay, I'm sold.
Yeah.
Money management is key. So let's talk about some practical techniques. What are some things that traders can actually do to protect their capital?
Well, one thing that the book talks about is using protective stops.
Protective stops.
Yeah.
What are those?
They're basically orders that you place with your broker to automatically get you out of a trade if the market moves against you.
So for example, if I buy a stock at $100 and I set a stop loss order at $95, my position will be sold if the price drops to $95.
Exactly. That way, you don't have to be glued to your screen all day, watching every tick. You're protected even if the market moves against you.
That makes sense.
Right.
But where do you actually place these stops? That seems like the tricky part.
It is. It's all about finding that balance. You want to give your trade enough room to work, but you also want to limit your potential losses.
So you don't want those stops to be too tight, because then you could get stopped out of a winning trade too early.
Right. But you also don't want them to be too loose, because then you could lose a lot more if the market really turns against you.
The book talks about using those technical factors that we were discussing earlier, like support and resistance levels, to help you figure out where to place your stops.
That's a great strategy. For example, if you're long a stock and the price breaks below a major support level, that could be your signal to get out.
So the market is kind of telling you that the trade is over.
Exactly. You're not relying on emotions or guesswork. You're looking at the objective price action.
I like that. Okay, so protective stops are important. What about position sizing? How much of your capital should you risk on each individual trade?
That's a great question. And it's one that every trader has to grapple with. The book suggests risking no more than 1–2% of your total capital on any given trade.
Okay, so you're not putting all your eggs in one basket, so to speak.
Right. It's all about diversification and managing your risk. That way, even if you have a string of losses, you're not wiping out your entire account.
But wouldn't that also limit your potential gains?
Possibly, but it also limits your potential losses. And remember, the most important thing in trading is to stay in the game. You can't make money if you're out of the market.
It's a good point. So how do you actually figure out the position size based on that 1–2% rule? It seems kind of complicated.
It's not that complicated. Let's say you have $100,000 in your trading account and you're comfortable risking 1% on a trade. That means your maximum risk for that trade is $1,000.
Okay, $1,000. So how do you turn that into a specific number of shares or contracts?
That's where your stop loss order comes in. Let's say you're buying a stock at $50 and you set your stop loss at $48. That means your potential loss per share is $2.
Okay, so to stay within that $1,000 risk limit, you could buy a maximum of 500 shares.
Exactly. Because if the stock drops to your start price, your total loss would be $1,000.
Wow, that's really clear. I'm starting to see how position sizing is just as important as finding the right entry and exit points.
Absolutely. It's all part of managing your risk. If you don't have a good risk management plan, you're not really trading, you're gambling.
Right, that makes sense. Now, the book also talks about the importance of having a trading plan. What does that mean exactly?
A trading plan is basically your roadmap for navigating the markets. It keeps you focused, disciplined, and helps you avoid making emotional decisions.
So you're not just flying by the seat of your pants, hoping for the best.
Definitely not. A good trading plan outlines your goals, your trading style, your risk management strategy, and your entry and exit rules. It keeps you accountable.
So it's like a business plan for your trading activities.
Exactly. And just like with a business plan, you should write it down and review it regularly. Make adjustments as needed.
So it's not something you just create once and then forget about.
Definitely not. It should evolve as you gain more experience.
Now, another thing that the book talks about, and that I think a lot of traders struggle with, is the psychological aspect of trading. How do you deal with the emotional ups and downs?
Oh, that's a huge part of trading. Our emotions can really mess us up. Fear, greed, hope, despair. They can cloud our judgment and make us do things that we wouldn't normally do.
It's like our emotions hijack our brain.
Right, and that's why it's so important to have that plan and stick to it, no matter what. You need to base your decisions on logic, not on how you're feeling at that moment.
So even if you have a rule that says you'll sell if the price hits your stop loss, you have to follow that rule, even if you really believe that the market is going to turn around.
That's right. Consistency is key. If you start making exceptions, then you're basically trading on your emotions, and that's dangerous.
Okay, that's a really good point. Now, the book also talks about the importance of managing your expectations. Trading is not a get-rich-quick scheme, right?
Absolutely not. It takes time, effort, and a lot of learning to become a successful trader.
And there will be losing trades along the way.
Oh, for sure. Even the best traders in the world have losing trades. It's part of the game.
The key is to manage those losses so they don't blow you up.
Right. And to focus on the long term, trading is a marathon, not a sprint.
Well said. I think this deep dive has given our listeners a lot to think about.
I hope so. We've covered so much ground, from the basic ideas behind technical analysis to those advanced techniques. And of course, we can't forget the importance of money management.
I think one of the biggest takeaways is that technical analysis isn't about predicting the future with 100% certainty, but it's about using these tools to help us understand the market and hopefully make better decisions.
You got it. It's about tilting the odds in your favor.
And it's about constantly learning and adapting. Never stop learning.
Right. The market is always changing, so you have to change with it.
Well said. And to all our listeners out there, thank you so much for joining us on this incredible journey through the world of technical analysis. We hope you've enjoyed it and that you're inspired to continue your own exploration of the markets. Until next time, happy charting.
Happy charting!